Hello and welcome to Sprott Radio. I'm your host, Ed Coyne, Senior Managing Partner at Sprott Asset Management. I'm truly pleased today to welcome back one of our returning guests, Ronnie Stöferle. Ronnie joins us today from Incrementum with over 11 years of experience at Incrementum as a partner, a portfolio manager, and a managing director. You've been busy over there, Ronnie. Ronnie brings over 2 decades of investment experience, and over the last decade plus has been hyperly focused on gold as well as gold equities and some other assets. So I asked Ronnie today to join us on Sprott Radio to really talk about all things, but in particular, as always, the In Gold We Trust 2024 booklet, which for those that love to read, it's over 400 pages. They've done a nice job of doing a summary as well. Always a great book to read, always one of my favorites of the year to look at. You do a wonderful job with that. So Ronnie, without further ado, thank you for joining Sprott Radio.
Many thanks, Ed. Always a pleasure. Hope you're well, my friend.
I'm doing quite well. It's still amazing you and I have not been in the same room yet together after a couple years, but at some point we have to fix that. So let's get right into it. I mean, wow, what a year for gold so far. What in the world's going on?
I mean, there's a reason we are writing 400 pages every year. And it's not about gold. Gold is just sitting there. Gold doesn't change for millions of years. It's just a world around gold that is moving more and more quickly and dynamic and crazy to some degree. So, Ed, last year the title, the leitmotif of the report was Showdown, and we said there will be a showdown in the price of gold because we've been flirting with this $2,000 barrier for quite a while, and actually it took us 4 years flirting with that price level, and now finally we broke out, and now we're entering a completely new ball game. We have entered terra incognita, and in the report we basically explain what has changed in the gold market and why there is some sort of a new playbook that we should study very, very closely. And this new playbook is highly influenced by the enormous amount of central bank demand, but then also emerging markets.
I love what you just said about the world has changed around gold. Gold has been very stoic. It just sort of sits there, does its thing. And there is a new playbook out there. So kind of walk us through what's new. How should an investor be thinking about gold today, and maybe a way they haven't thought about it in the past?
Well, I think we have to differentiate between the Western financial investor and what's going on in emerging markets. I think the marginal gold buyer now truly is in emerging markets, in the Mideast, in China, in India. I think that's a trend that we've been describing for quite a while, but now it really seems that both private demand from emerging markets, but also central bank demand from emerging markets is really decisive. Because if you have a look at the gold demand in the ETF space, actually it seems that Western financial investors couldn't care less about gold. For the time being, we had outflows from the physical backed gold ETFs. I think it was 780 tons since the year 2022. Then there was another great survey by the Bank of America that said, I think 71% of all asset allocators hold only between 0 and maximum 1% gold for their clients. So I think it's becoming much, much more of an emerging market story. And I think that's a positive thing because gold, as you know, is often being viewed as something for doomsday guys, people hoping that the end of the world is close, hyperinflation, civil war, and so on. But then actually this so-called love trade, physical demand from countries with a very high gold affinity, like China, like India, like Vietnam, like the Mideast. Dubai, for example, just one number, is responsible for 25% of the gold trade worldwide now. So I think this love trade is becoming more and more important. And at some point, I hope Western financial investors will also wake up and significantly raise their allocation to gold. So it is, first of all, this central bank demand that really has put a floor under the price of gold. We've seen all-time highs in central bank buying in 2022. 2023 was only slightly lower, and the first quarter of 2024 was another all-time high. And I think this central bank demand also primarily from emerging markets, is really the decisive driver now. And it started in 2022 because of the sanctions against Russia, where many central banks around the world kind of decided, okay, perhaps we've got too much dollar exposure. What they did to the Russian FX reserves, they could also do to us. So I think there's a broad trend of diversification of central bank assets. And there was a great report coming out from the World Bank in February. It was a handbook for asset managers in central banks. And they said for emerging markets, central banks, they advise up to 22% gold allocation for their central banks. So I think this trend will continue and is really a game changer in the global gold market.
It does seem that the rest of the world is maturing. We see it at Sprott all the time as we go into critical materials for the energy transition. The rest of the world wants what the typical Western world has had, and maybe there is a shift on who's buying gold. In your mind, what does gold look like from just a general price standpoint if the Western world starts to embrace gold the way the East has? What would that look like in your mind?
Obviously, prices should be higher. It might be anecdotal evidence, Ed, but I did quite a lot of keynotes recently in the German-speaking world, especially in Germany, in Austria, and in Switzerland. And I did my keynote, and I would say the majority of people sitting in the audience, they said, okay, now is the time to sell gold because prices are so high. I mean, the reason could be that my keynotes were really, really bad. But I think the general sentiment is nobody can envision, nobody can really comprehend that gold actually is quite cheap at the moment from my point of view. I wrote my first In Gold We Trust report in 2007. I think the price of gold was at 500 or 550 bucks. And now, where we're trading at roughly 2,400, I'm significantly more optimistic on the price of gold. And I think, with this emerging markets trend, let's not forget in the year 2000, only 19% of the world GDP was produced by emerging markets. 2024, it will be more than 50%. The majority of all the GDP growth is coming from emerging markets, and they've got a culturally higher affinity for gold. So gold is this sort of, as Louis Vicent Gaff called it, it's a low beta proxy for emerging markets. And I think that for the Western world, at some point, we will probably also see some sort of FOMO kicking in because the price of gold rose from 1,800 bucks last fall. Now we're trading around 2,400 bucks. So it was really a big, big move. Normally, I would tell you, well, actually, we should take a breather. Sentiment was extremely positive. We're seeing that commitment of traders report looks like a correction should happen. But the price of gold is just not coming down. And this is telling me that actually there are so many buyers on the sideline. They just buy into every minor correction. And this is classic early bull market action. We're not only seeing this when it comes to the price of gold, we're already starting to see that silver is starting to outperform gold. We're seeing that there's stronger volumes kicking in the minor space. So we're seeing some early stage, I would say, outperformance from the mining stocks versus gold. So this is everything you want to see at the early stages of a new bull market. And just one more thing, Ed. I told you that we've been flirting with this 2,000 US dollar barrier for almost 4 years. If you go back to the previous big breakout, which happened in fall 2009, before that, the price of gold was flirting with this 1,000 US dollar barrier. Also from a psychological point of view, a very important number. So gold broke above 1,000, I think the first time March 08, when Bear Stearns actually went down. But then it took us 1.5 years to finally break above that 1,000 US dollars barrier. And afterwards, after this breakout, price of gold almost doubled until summer of 2011. And I think we're seeing a somewhat similar development at the moment where slowly but surely people are realizing that gold has finally broken out and this is a new stage of a bull market.
Well, you made a comment, or I read in the report, there was a great quote about owning gold versus buying gold. And the other comment you made, I think, which is a really solid comment, is that at 2,400, you still think this is attractive. I always like to say gold's a relative asset to the rest of the other assets around you. Can you talk about that a little bit? How should an investor think about gold in their portfolio from an owner standpoint versus buying or trading it? How should one view gold as they look to potentially allocate to this space?
It's relative valuation. And I think, I do regard gold as a monetary asset and not as a commodity, because gold has a very high stock to flow ratio, and that's a big difference compared to pure commodities with a low stock to flow ratio, like copper, for example, even though copper looks super exciting at these price levels. And I think that's also some sort of a sign that we're seeing some movement in the commodity space. However, just one number for the United States, and this clearly describes this monetary climate change that we described in a previous In Gold We Trust report. We should focus more on fiscal stimulus and less on monetary stimulus. So actually what we're seeing in the United States since the eve of the COVID pandemic, Q4 2019, US debt is up by 11 trillion US dollars. And obviously, previously, we were kind of getting used to zero interest rates. But now at these interest rates, those numbers for interest payments, they're becoming quite significant. So if we stay at current interest rates, next year, interest payments for the United States will be 1.7 trillion. What's the US GDP? I think it's 24, 25 trillion. So 1.7 trillion just interest payments. That's pretty significant from my point of view. And this is telling me that it's not only the US, it's obviously we're seeing the same in the Eurozone, with a French debt crisis seemingly building up. We have seen some stress in the Japanese banking sector. As I've said, from a relative point of view, I think gold is still fairly undervalued. Now, the second part of the question that you described, I think it's important to differentiate between what we call safe haven gold. This should be physical gold. You should care about counterparty risk. You should care about, safe jurisdiction. And the other motivation that you can have for owning gold is just making performance. Performance gold would be silver, mining equities, obviously, and so forth. But I think that has to be really differentiated. Physical gold as a safe haven asset, and then on the other hand, performance gold via mining stocks, for example, which have completely different risks, but also bigger upside.
Let's talk about performance gold a little further for a minute, because we've seen a huge disconnect between what gold has been doing relative to the miners. You've seen this movie before. So how should investors be thinking about gold miners in particular?
I mean, to be honest, many people are super frustrated with the performance of the mining space. And I think that it is now really time to rebuild trust in the sector. And from my point of view, the industry has done a tremendous job over the last couple of years. They really cleaned up their balance sheets. They reduced debt. They're producing enormous amounts of free cash flow at the moment. So I think now, from a contrarian point of view, it's an excellent setup in the mining space. However, I think one of the reasons why mining stocks underperformed gold over the last couple of months is probably because emerging market investors, they prefer physical gold. They tend to buy not so much mining stocks. I think that's one of the main reasons. And then on the other hand, many companies came out in Q1 with very high forecasts for their all-in sustaining cash costs. So now we're seeing costs kind of moderately rising this year. So which means that with current performance of gold, we will see enormous amounts of free cash flow in the mining space. I think what's crucial to say is, I'm doing this for a couple of years now, and from my point of view, gold mining stocks are probably the most top-down asset class. So historically, bull and bear markets in gold shares have lasted much longer than average mining stock cycles. But those super cycles are often triggered by fundamental changes in monetary conditions. And I think now is really, really the time when just looking at the sheer numbers, many investors and probably rather the generalist investors from outside of our, let's say, gold and commodities bubble, they will realize at some point, well, there's actually tremendous valuations to be found in the mining space. And we have seen that, for example, for the large caps, like in Newmont Mining, for example, there was really some big volume kicking in recently. And usually generalist investors tend to buy into the large caps and the most liquid names first. And, from a valuation point of view, again, it might be anecdotal evidence, but I was at a conference with roughly 300 private bankers managing significant amounts of money. And the conversations at breakfast, coffee break, lunch, afternoon coffee, dinner, and drinks at the bar, there was like only one topic. It was NVIDIA. Everybody was talking about NVIDIA. So, NVIDIA at the moment, it's, what is it, roughly 3 trillion market cap. That's 10 times as much as all the gold and silver miners in the whole world. From a relative point of view, I think that's quite telling. And again, companies, the quality names in the space, they have done a pretty good job over the last couple of years getting their balance sheets in order. And I think now is really time to harvest basically from what they invested over the last couple of years.
Yeah, and I think on top of inflation, at least potentially softening, you got to believe the margins will continue to strengthen there, particularly if the price of gold continues to escalate. I know, in reading your report, you believe that, and a lot of the statistics out there support that as well. Let's talk about price for a minute. I don't want to hold your feet to the fire on this. Some people are always reluctant to talk about price, but at current rates of over 2,300, what does the rest of this year look like? Have people missed the current move? And I know we talk about, the price of something versus the value of something, or owning versus buying. And then what does maybe the next decade look like to you? If you had to go through the end of this decade, what does that look like to you? If you could talk about that for a minute.
I had a look at the CPF function on Bloomberg quite recently, and this is showing you the analyst consensus for gold by all the big names, all the big Wall Street banks. So the consensus for 2025 is $2,100 next year. For 2026, it's $2,000. For 2027, it's $1,850. Now, this is telling me that actually the majority of all analysts working for the big banks on Wall Street, they're still extremely bearish. They haven't realized that this is a bull market that will continue for the next couple of years. Now, as I've told you, I thought from a technical point of view at 2,400, I thought that, wow, now it's really time to take a breather for gold to correct. But this correction it's a very shallow one. And this is an enormously strong sign because, as I've said previously, it shows you that there's so much capital on the sidelines and they're buying every minor dip in the price of gold. So therefore, I think that 2,600 is pretty realistic by the end of the year. I think our long-term price target is $4,800. We already forecasted that in the In Gold We Trust report 2020, where we said, okay, for this decade, we lay out our framework where we said inflation and inflation volatility will be a big driver. As you know, in 2020, nobody cared about inflation. It wasn't a topic at all. So we said back then, we describe our monetary model. You can read it up in Gold We Trust 2020. And based on that model, we came to the conclusion that $4,800 is a realistic target for the end of this decade. Now, it sounds crazy, but who would have expected at the beginning of the 1970s that gold would rise from roughly $30 up to $850? So from here until $4,800 by the end of this decade, that's a CAGR, compound annual growth rate of 12%. I think, it's optimistic, but from my point of view, it's pretty realistic. So as I've said before, it's a new stage of this bull market. We're seeing early bull market action with silver starting to outperform gold, with mining stocks really waking up. And that makes me pretty confident in combination with the fact that everyone and their mother in the Western world is still not really allocated in gold, and the big banks are super bearish on gold.
Well, and it also seems that, we have, I guess, relatively, they aren't really high yet, but they're higher than what they were the last couple of years. Interest rates. So typically that's the opposite that hurts gold. Economy, depending on who you ask, is still strong and growing. And the markets are rewarding investors still to buy equities, yet gold continues to do well. So this is before we get any cracks in the foundation. So as high as that 4,800 sounds, it actually seems pretty rational when you look at gold's doing well in a good environment for everything else. What happens if everything else starts to look a little more wobbly, or if debt starts to matter again, or if rates start coming down? What does that look like? Any thoughts on that?
Ed, I mean, one of our major calls last year was that we said that a recession is on the horizon. And we've been wrong on that, obviously. For the United States, not so much for Europe, and also China not doing so well. But why is the US economy doing so well? I mean, if I pour in, what was it last year, 1.7 trillion of fiscal stimulus, if I run a 7-8% budget deficit with full employment, I mean, it's pretty easy to make growth numbers look good. It's like if you should actually sleep and then you're getting like 3 Red Bull and 4 cups of coffee, you'll probably stay awake. But it's not a very healthy strategy, I would say. And we have seen recently that some numbers that we follow quite closely, they're cooling off. And then on the other hand, I tweeted that out. The expectations for a soft and a hard landing, they have actually collapsed. So everybody is now really buying into this Goldilocks scenario, everything going fine, inflation numbers coming down. Fed has done a tremendous job in managing the economy. That's like the consensus. I'm a little bit critical when it comes to that, to be honest. However, I would say that at the beginning of this year, the market was discounting 7 to 8 rate cuts. Now we are at 1 or 2 rate cuts. And still the price of gold is trading close to all-time highs. I think this shows this enormous strength of the price of gold. And this confirms this new gold playbook that is, of course, heavily influenced by emerging markets demand. And just have a look at the crumbling real estate market in China. China is definitely one of the most important drivers in the gold market at the moment. The potential for further gold purchases is enormous. China holds, I think, 108% of their GDP is just the cash holdings by private Chinese individuals. There's not too many alternatives to the real estate market, and gold is the obvious choice for Chinese investors. So I think this bull market is really standing on a very, very solid foundation. It's central bank buying, it's emerging markets demand. It is the potential for Western financial investors to come in, probably at the point of time when a recession and significantly lower rates, and at some point yield curve control, another round of quantitative easing, and so on, will be priced in. And that makes me really, really confident going forward. Gold trading so close to all-time highs and seeing so much bearishness and agony, that's really that's a brilliant sign.
We just scratched the surface on this year's report. And for someone who wants to really dive deep into it, how can our listeners find the 2024 In Gold We Trust report?
Yeah, thanks, Ed. First of all, I have to say, it's not just Ronnie writing the In Gold We Trust report. I've got a tremendous team of 20 people on 4 continents contributing to this report. And it's always lots of work and lots of capital that is invested and lots of love and sweat and tears. But it's really worth. And I love just the feedback that we're getting from all over the globe. And the report is available totally free of charge. You don't have to register. You don't have to give us your email address or anything. You can download it from our webpage, ingoldwetrust.report. You can download the full report, 440 pages. There's also a compact version. We've got our monthly gold compass, which is a collection of the best charts that comes out on a monthly basis. And yeah, lots of other publications. We've got so many plans actually that we will work on over the next couple of months. So have a look at ingoldwetrust.report. You will find all the information on our webpage.
Well, Ronnie, thank you as always for making the time to join us. And I also encourage our listeners, you did a wonderful job summing up the report in the most recent YouTube video as well, which I actually gave a listen to this morning. You did a great job with that as well. So for all of our listeners who want to learn more about not just Incrementum and what they're doing and the work Ronnie's doing, but just gold in general, I highly encourage you to take a look at this. It's a really useful tool. I sort of build my next 12 months around this report every time it comes out. So I've sort of lived off that the last few years, and I can't say enough of great things about it. So thank you and your whole team for doing that work. Any last parting shots you'd like to throw out there, Ronnie, before we sign off?
Great quote that I've just heard that fits very much, I think, to this differentiation between safe haven gold and performance gold. I don't know who actually said that, but I loved it. It is save like a pessimist, but invest like an optimist. Ed, thank you very much for having me. Always a pleasure talking to you.
Thank you, Ronnie, and I'm looking forward to someday actually meeting you in person.
Absolutely, absolutely.
This podcast is provided for information purposes only from sources believed to be reliable. However, Sprott does not warrant its completeness or accuracy. Any opinions and estimates constitute our judgment as of the date of this material and are subject to change without notice. Past performance is not indicative of future results. This communication is not intended as an offer or solicitation for the purchase or sale of any financial instrument. Any opinions and recommendations herein do not take into account individual client circumstances, objectives, or needs, and are not intended as recommendations of particular securities, financial instruments, or strategies. You must make your own independent decisions regarding any securities, financial instruments, or strategies mentioned or related to the information herein. This communication may not be redistributed or retransmitted in whole or in part or in any form or manner without the express written consent of Sprott. Any unauthorized use or disclosure is prohibited. Receipt and review of this information constitutes your agreement not to redistribute or retransmit the contents and information contained in this communication without first obtaining express permission from an authorized officer of Sprott.